don't care what day it is. Going hard is the narrative. You only live once, gotta cherish it. Revenge tastes good, I'ma cherish it.
All right, guys, the Austrian Hispanic here. It is Tuesday, the 2nd, October the 2nd. It's the end of third quarter. We're now heading into the fourth quarter, and I just really want to go over a few things with you guys that I think are going to interest you. So first, overall, we're going to go over the Fed raising interest rates, the flattening and inversion of the yield curve, the significance of this, XDR USD, XDR XAU, XAU USD, XAG USD, which essentially is special drawing rights relative to the dollar, special drawing rights relative to gold, gold dollar, silver dollar. Now, I touched a little bit about what are special drawing rights, essentially the IMF's reserve currency or basket of currencies. But so we had the Fed raise 25 basis points, and this is bearish suppression in gold and silver markets. It really has taken a hit, really keeping gold under that 1200 handle and silver at 14 and change, kind of bounce around range trading for quite some time. Now we have a lot of gold speculators pegging the special drawing rights, the XDR to 900 gold. So for every ounce of gold, you have 900 SDR. That is that's going to be the in the new GMR, the Global Monetary Reset. That's going to be the new standard, the new reserve status for gold in the basket. IMF will bail out central banks, and the IMF. So first we had last crisis we had the central banks bail out the banks, and now we're gonna have the IMF bail out the Federal Reserve. And one thing that I want to touch with XDR is the fact that we have the dollar at 41.73% of the basket, and then we have euros, yuan, Japanese yen, pound sterling, but dollar is essentially the majority of the basket. It's 41.73. Once we start seeing a decline in the dollar, we're going to start to see gold being incorporated a bit more into the SDR. We'll see euros, yuan make more of a have more of an impact, be more of the basket, and reduction of the dollar. But one thing that I want to touch as well is the global debt bomb. We have debt and derivatives is over $1 quadrillion. It's massive. Global debt and derivatives. What are derivatives? Derivatives are instruments that are derived from the underlying asset. Let's say a stock. You have futures contracts and options and all these, instruments that are, you're not buying the asset itself. You're using it, to place your options or futures trades. But what this is when you have such a massive bubble in global debt and derivatives, and it's mostly pegged to dollars. Then once the dollar starts collapsing, then we'll see a snowball effect with debt and derivatives. Another thing is XRP. I'm not a big fan of cryptos per se, but there's one that's caught my eye. Not because it's decentralized and it's like Bitcoin and it's all this hype. It's essentially the complete opposite of Bitcoin. It works with banks. It has a purpose. There's a functionality to XRP Ripple, and that function is settlement and remittance. What that is when you're trading one currency to another, there is a delay of 1 day, 2 days before the contract is settled. XRP is essentially instantaneous settlement, And the significance for this is that it's going to dethrone SWIFT, the FedWire, and CHIPS. SWIFT is it kind of worked like the bank. They're a communications company, and they, for example, if you have one bank, let's say Credit Suisse, they want to send money to a bank in England, or let's say HSBC. So they want to send some money to them. They have these euros, and they want to settle the contract in pound sterling. So they have to go through SWIFT, and then SWIFT, they through their process, they wire the money to other banks, up to HSBC, and it takes about 2 days. Well, XRP is instantaneous; it's fractions of a second, and it's interesting how it's either they're going to be the new system, or we'll see an adoption of this technology into FedWire chips, which is the Chinese uh, um, the Chinese it's the Chinese it's the Chinese FedWire, and they're very, very secretive. They're not like FedWire, but we see that Iran just they got de-swifted a few years ago with sanctions, and we're gonna see that again. They're getting de-swifted. They're getting a hard time selling their oil and buying other stuff, because the way that it works is that these are the choke points. So when there's companies that want to do business with Iran, they want to buy the oil, they want to do development plans, but the U.S. is saying, "Hey, don't do deals with Iran, because Iran, they're not a good player, and they're not. They do a lot of nasty things. They fund a lot of nasty organizations with good reason. But I think this is going to be another circumvent to FedWire and SWIFT. So let's go into what Ross Leckwell said. He says regulators have an opportunity to learn from new products as they're being tested in ways that will inform regulation. So it's kind of still at that phase. We're seeing a new era in remittance, and they initially Ripple they were using a platform that was called Xcurrent, and then they had another one. They did away with that, and if you go to their website, they just have this new platform called RippleNet, and that's supposed to be launching sometime by the end of this year, sometime by the end of next year, and we'll see uh, XRP take a spike. Right now, it's trading at 58 cents, 59 cents. You want to round it up. You have your pips, which is percentage interest points. It's about 58,884. That's the pip interest. But if you go back into where it was a few months ago, it was trading at 93, kind of took a hit. It spiked up September 19th from 37 cents to where it is at now. Then I think that the resistance is that 92 handle, and then if you go just a little bit further back, $1.24. So that's XRP relative to a dollar. Now I think my assumption is that XRP, the main pair for XRP will be XRP Gold, XRP Euro, XRP Renminbi. But we do see a lot of banks taking note of XRP, and as we can see, there's a laundry list here. We blow this up. Let's just go over some of the banks here. UBS, UniCredit Group. Those are the ones that are partnering with XRP. Down the road, I think we will see central banks cooperate with this technology, or have some role in it, since it's much faster, it's much cheaper to do it this way. Gold Gold has been, if you go into our charts with gold, it's trading at 1203. It's been still at this range for quite some time, and then my assumption is that we'll see an iceberg order squeezing the longs. Because the banks, they don't want to do business up. They don't, when they're putting in their block orders. It's very difficult for them to put these block orders up. It's just making it more and more expensive for them to do these block orders up here. So what they'll do is they'll short the market and squeeze some of these longs here into selling, where they'll buy, and then boom, we'll see a skyrocket, maybe at that 1235 handle, and then bounce again in that range of 1235, 1211 range, and then from there, sky is the limit. Silver's, we've seen a little bit of a peak here from September 16th. We've seen a little bit of a rally. If let's measure this, see where we're at here. I want to measure from here. You've seen for about 15 days, 2 weeks, a 6.28 increase to 1470, or it went up a little bit this previous candle, and then kind of came back, closed at that 1470. And let's go back to gold a bit. So looking into what's going on with Russia and China, and they're just buying gold and selling treasuries. We have these sanctions that are being imposed on Russia and China. So what they're saying is, hey, we have all these treasuries that we don't need. Let's get rid of them. Let's buy gold, because that's, as much as central banks want to say that gold isn't money, and that it's an arcane, we shouldn't use it. They buy gold. They deny it, but they, in secret, they buy it and they hoard it. So we see again, Russia and China buying. They're both about 2,000 tons of gold. The U.S. is about 8,000 tons. EU in total about 10,000 tons. And from my understanding is that gold refiners, especially in Switzerland, they're having a hard time keeping inventory, and because it's just so cheap, and these central banks aren't idiots. These guys, they know what's going to happen, and they're anticipating. They're buying at these good prices. So going into the dollar index, we see a few things that I just want to stress with you guys, as far as number one, Amazon just raised the minimum wage. That's putting pressure on jobs. It's putting on them hiring more people. That's putting pressure on prices. They're gonna have to raise their prices. They're gonna have to cut jobs. They're gonna have to use more machinery, which I like. I'm an Austrian. I think that automation is a great thing. I'm not one of these guys that say let's go back to having labor intensive capital. So we have Amazon doing this, and it's going to be a snowball effect. Bernie Sanders, he's giving it a thumbs up. He say, "Let's great, let's raise wages." But here's the thing: you don't have to raise wages to raise living standards. Just improve your value in the market. That's the way to improve your living standard, not by raising wages. That's just smoke and mirrors, because when wages go up, so does everything else. So does prices. So, that's again the socialist mentality is, let's just raise wages. Why don't we just raise everybody's wages? How about that, Bernie? Why don't we just, give everybody $100,000 check every week? Doesn't work that way. There's a difference between money. They're similar, but there's a difference between money and capital. Money is, paper, fiat currency, and capital is a value that it brings, or the value that it holds. So and Q2, the Fed flows fund report reveals that state and local unfunded pension liabilities revised from 1.8 trillion from Q1 to 4.1 trillion in Q2. That's huge disparity. We're seeing this divergence in debt to GDP ratio and the velocity of M2 money supply. M2 money supply, if you go a little bit into what is fractional reserve banking, we see that it's starting to lose momentum. Let's say M0 is when the Fed prints out money, and then down the road, M2 is deposits and checking accounts, and how the banks use that to make more loans, to perpetuate that debt. So we're seeing this big divergence, this alligator divergence, and it's massive. And I think this is going to be, if not the catalyst, one of the things to kind of pivot our economy into recession. The biggest debt bubble since 2008, and that was with a strong dollar. So we're seeing spending outpacing savings and income for four consecutive months. And as I mentioned last time, that we are seeing a slowdown in the retail homes market. People aren't buying as many homes. Just another indicator of a bubble and not a robust market. All right, guys, I just want to thank you again for tuning in. This is very vague. I'm just kind of getting the grasp of this, but I just want to thank you guys once more for tuning in, and I will have things more in detail as I kind of develop my mosaic theory. But this is Austrian Hispanic here, signing out for October the 2nd.